Okay, so now we're going to look at section 6. So we're in the second part of this session. Okay, so this part is looking at the typical basic structure of a PPP project, how private finance PPP project is financed, the causes of project failure, the introduction to the framework, and an overview of the PPP process. Now, I will say to you that the PPP process cycle is made up of 6 phases. Now, you will be asked what happens in each phase, which is the first phase, which is the second phase. If you don't know that, you will lose quite a lot of marks in the exam. Indeed, not only will you be asked questions of which phase something happens in and what's the order in this particular exam, but also at the preparation and execution levels. So if you've got a friend or a partner or a family member who can just test you on which phase happens first, second, third, fourth, and what those phases are called and what happens in them, that will be a very helpful thing to do for the exam itself. Okay, so basically the basic structure of a PPP project is to have what's called an SPV, a special purpose vehicle. Now, in local legislation in different countries, they may have a different name. Things like single purpose vehicle, single purpose company, single purpose enterprise, and so on and so forth. Now, the fact that they're often called single gives away the fact that they can only ever have one project in them. Now, the project may consist of 100 schools, but it's being contracted as a single finance project or as a single of a management contract. So S actually stands for special purpose vehicle. Now, the project structure the SPV is defined by the project structure and contract structure and explains the concept of pass-through and the linkage between the PPP contract upstream and the downstream project contracts. So the upstream is what we have is the government will define the contract or the authority, and then the SPV will sign the contract. Now that contract will have been defined upstream by the authority. The downstream project contracts are those contracts that are defined by the SPV and signed by the contractors and subcontractors to the SPV. So the downstream are those project contracts that are signed between the SPV and its own contractors. Now, those contracts are normally back-to-back contracts, and the risks will be passed on down through the various contractors. This section also includes a payment mechanism as a key element of the PPP contract structure. So the guide describes a payment mechanism as the approach that's taken to paying the private sector by the public sector, normally for a government pays project, because it's saying you have to make sure that the building is available, that you're performing to your to the contracted standards, and if you are, then under a certain mechanism we will then pay you. So let's say we have a hospital building that costs $365 million a year. That means that each day it costs $1 million. If that hospital was not available, it was not couldn't be used for a day, then the authority has the right, not the obligation, but the right to deduct $1 million from the contractor. $365 million. The hospital's not available for 2 days, then it would be $2 million that the public sector can deduct from the private sector, and so on. Okay, so that would be a very simple payment mechanism. Obviously, it's more complex than that. Now, with a user pays concession, that is a bit different, because the mechanism for a standard one is simply would be you use the toll road, you pay. So we wouldn't normally say there's a payment mechanism for the concession. However, if the government is involved in making payments, social payments, maybe it's actually paying shadow tolls, then that also would become a payment mechanism as well. So here, here we have the typical structure that you will see in most documents actually for the project structure. I will say that the only thing that you normally see that would be different is these might be reversed, and indeed these might be reversed, but the only reason they do that is because they want to draw it in a different way. So first of all, the bid comes in, the authority issues a bid. So the consortium, which will be these people here, the construction company and the O&M company, they will put a bid in to the authority. The authority will evaluate the bid, and eventually they'll evaluate all the bids, and they will get a shortlisted group. That shortlisted group will then be reviewed, they will be evaluated, and one of them will be awarded the contract. After it's awarded the contract, then the bidder has to fulfill what are called the conditions precedent or precedent conditions in the contract, and that might mean setting up an SPV. When they set up the SPV, the construction company and the O&M company become equity investors. And then after they've become equity investors, the authority will sign the contract. This is the upstream contract with the SPV, and that will be for the design, build, operate elements of it. The finance normally is down to the supplier, but there will be, here it calls it a direct letter between the authority and the lender. It might also be called a direct agreement. It says that in certain circumstances, if the SPV is looking to fail, that the lender's lender's representative will be selected. They may be sent to stand in, so they'll take over the company, and then there'll be arrangements between the lenders and the authority with regard to dealing with that particular issue. So the guide explains the payment mechanism in the context of other sources of revenue. It mentions that it's the heart of both the financial structure and the risk structure. Please make sure you are happy with financial structure and risk structure as terms and what it says about them in the guide. The payment mechanism, the design can align the interests of the parties and ensure effective risk transfer. There is that failure. The failure means that they don't get, the private sector doesn't get paid, therefore they are taking on that risk. Okay, and then it talks about those types of payment mechanism, which could be availability and quality, or you may have something to do with volume versus availability and quality. So a typical finance structure is based on what's called non-recourse, limited recourse project finance techniques, limiting the risk exposure of the investor or promoter of the project. So basically, we could have what's called corporate finance. Now, you're a big company, and you can finance something based on your balance sheet. So when the banks go out and look at you and see whether or not you can deal with a loan, they look at your balance sheet. Now, with project finance, they don't do that. Basically, a SPV is set up, and then the private sector lenders look at the cash flows that flow within the SPV, and it's that those cash flows, that is the asset, that is what is important to those lenders. Now, they can't go back to, if anything happens with the SPV, they can't go back to the parent companies and say, oh, we pay up, you know, it's failed. But there is some limited recourse, and that's normally during the build phase, where the SPV will give some limited guarantees to the private sector. Sorry, the SPV, but it's very limited. So recourse finance or normal recourse would be corporate finance. Non-recourse finance is where there is no recourse to the parent company, but limited recourse finance is where there's limited recourse to the parent company. And that's what we have on PPP. So the typical financial structure is based on non-recourse, limited recourse project finance techniques, limiting the exposure, the risk exposure of the investor, promoter of the project. And it says project finance is based on the financial analysis of the complete life cycle of a project. So cash flows generated by the project must be sufficient to cover payments for operating costs and to observe the debt in terms of capital repayments and interest. Project finance requires a high level of due diligence and control by lenders over and above that undertaken for corporate finance. And finally, an SPV is usually established in order to deliver the project, and this ring fences the project finance and limits the risk exposure of the parent companies. So an SPV is a separate legal entity created by an organization. It's a distinct company with its own assets and liabilities, as well as its own legal status. It's created for a single purpose, for example, to isolate risk. And typically, the key forms of special purpose. And typically the legal forms of special purpose vehicle are partnerships, legal partnerships, or joint ventures. So this SPV is really important, really critical and core to what we're trying to do here. So first of all, we have the authority, the bid, and the bidding consortium. We mentioned this before. And remember, the typical legal forms of special purpose vehicles are partnerships, limited partnerships, or joint ventures. Very important question. And here we can see the risk is high at the beginning, it falls, and then it starts to get high towards the end. And that's really what this story is telling us. Right, now, does anybody in the chat box want to tell me what is hidden under the blue here at the top? What's under the blue? So we've got government, yeah, so that would be the authority. Oh, sorry. Oh, this should have, it should have opened it up, don't worry. So that's government. What is under this box in the middle? What's under the box in the middle? The SPV, okay, the special purpose vehicle. What is under this box here? The investors, yeah. So they are the equity shareholders, right? Who are these people here? Remember, there are lots of clues inside the arrows. Whoops. The users, yeah. Right, now, either of these, one could be one or the other. So what's this one here? That's one of the contractors, yeah. Normally the FM contractor. And this one? So these, yeah, that would be typically your EPC contractor, so your build contractor here. Okay, and then this one here, finally. Yeah, okay. Right, now section 7, it depends what your individual backgrounds are. Section 7 is considered by most people to be the most difficult section because it's got a lot of finance in it, a lot of detailed stuff that people don't like. So a lot of reading, and I think you can take as long to read section 7 as you do to read the rest of the guide. So just be aware of that. So it has a distinction between funding and financing. Now, basically, in a nutshell, financing is the money that's required up front. So the loan, the co-financing. Now, remember, a government that gives co-financing is actually a grant, a government grant. But financing is that upfront money. Funding is the revenue expenditure or revenue income, rather, that the SPV gets. So tolls, toll income, that kind of thing. Private finance and project finance. Well, private finance is just private sector money. Project finance is around this ring fencing of all the financing of a project, that it ring fences the asset, the cash flows. The lenders are looking to see that there's a positive cash flow within the deal, because obviously they are going to be lending to this company and it wants to make sure that they can repay the money. Then looking at different types of funds and categories, things like bond finance, we've got soft loans, we've got all sorts of support. It talks about infrastructure funds and financial partners, and you will be asked about financial partners, the type of partners there are, what a limited partner means and who they might be. And then there'll be something around what financial structuring means in the guide and the strategy. Then an important section is the role of the multilateral development banks, like the Asian Development Bank. It provides, for example, finance. It provides financial support for the authority, so bringing in expertise as required. Co-financing, the reasons and the variations, and then other forms of public participation and or intervention. And then finally, other considerations regarding the project's company's financial structure that influences the PPP contract. It then talks about the concept and rationale of leverage. So there's typically a question that talks about the weighted average cost of capital. Now, we want equity to be invested by the equity shareholders, because the English phrase is skin in the game. It means that we're putting some money in, the private sector are putting money into this deal. So they want, it's at risk, that money, so they want it to be successful. So it's really important that we have some equity. But if we have lots of equity, that's going to push up the cost of capital. Why? Because whenever we put capital into a company, we have to make a return on that capital. And the most expensive form of investment is in equity shareholding, because it's the riskiest. The lowest is normally the government, sorry, not government, will be the bank's senior debt. That comes with the lowest interest rate, because the banks will have lots of guarantees and safety clauses to make sure they get their money back. So that's the lowest risk cost. The highest risk cost is equity. So what is the weighted average cost of capital? You take the equity and you take the debt, the various types of debt with their interest rates, and you blend them. And if the weighted average cost of capital is high, you can reduce the weighted average cost of capital by having more borrowing, more senior debt. Or if you want to increase the weighted average cost of capital, you could increase the the amount of equity. Right, so that's important. Then we have the loan life cover ratio. Look it up and learn it. And also, some people call it the long life cover ratio. That's incorrect. It's the loan life cover ratio. And then finally, the debt service cover ratio. So the debt service cover ratio and the loan life ratio. Now, the normal route would be project finance. There are major concerns of the lenders, and we'll go through those quickly. And then we look at these ratios, bankability, and the typical range of leverage in project finance and excessive leverage. So you need to make sure that you are familiar with this. How we obtain money from the lenders? Focus for lenders is on the expected revenue stream. Lenders consider the project as distinct with its own project assets, project-related contacts, and project cash flow. So lenders need to be confident that there is an agreement to complete the project and a commitment to provide the funding to provide all the funding will be necessary. An established demand for the project output so that the project will generate sufficient cash to meet all of its operating expenses and debt service requirements, and assurance for the availability of adequate funds during the operation phase of the project to maintain and restore the project in operating condition. Sorry, excuse me. Now, these are the major concerns of the project lenders. Now, I'm going to do what I did before. I'm going to switch off my camera. I'm going to still leave the mic open. I want you to spend the next 3 to 4 minutes just reading this box of major concerns of project lenders. And when you're doing so, and after this session, just go back and have a look and see what that absolutely thinks in terms of how you can do PPPs locally or nationally. Another 4 minutes or so. Just have a look down, make sure that you feel comfortable, and then think, how do they relate? Some of them relate to the public sector. Some of them relate to the market. Some of them relate to the project itself. Now, as it happens, you can see that the source was adapted from the World Bank's book, which was produced by Farquharson, Torres, Yescom, and Encinas. And in fact, Farquharson worked for me and is an excellent PPP practitioner, currently works for the World Bank out of Washington, I believe. Okay, has anyone got any questions on these? Think about them in the context of your own country, the areas that you might work in, and how these might be addressed. I should say actually that the third bullet point is actually part of the second bullet point. Right, okay, so thanks for that. Very important slide, along with the rest of the important slides. Now, private finance, it says, requires an SPV. It enables the sponsor's exposure to be limited to other equity investments. The lenders will consider the project cash flow as an asset. The lenders require assurance the project will be delivered as planned, and the lenders will consider technical financial feasibility studies, as well as the creditworthiness of the project. Now, although it says private finance requires an SPV, if a question comes up in the exam that says that PPP requires an SPV, that is not correct. PPP does not require an SPV. Indeed, in some countries, it would be illegal to have an SPV. In others, actually, it might be a requirement. But private finance, first of all, doesn't require an SPV because it could be corporate finance that doesn't require an SPV, or it might just not be an SPV. Technical feasibility. So can it be done on time, cost, and to standard? Will it operate at planned capacity? Are the estimates accurate? Consider the environmental factors on construction and operation. Financial feasibility, positive NPV. Debt service cover ratio is acceptable. The loan life cover ratio is also acceptable. Now, in terms of financial structure, we have here the different kinds of debt. We've got the equity, which is capital shares, followed by some junior debt, which we might consider to be junior subordinated or mezzanine debt. In terms of that debt, we could have loans in terms of bridging loans and so on. We could have bonds or project bonds and other debt structures as well. Again, read each of these. The guide goes through how an infrastructure fund works. So we might have a national infrastructure fund. It could even be a fund that's managed by the very department that is letting the contract. I don't agree with that myself. I don't think that should be allowed, but it's possible. The types of investors in a fund, they're limited partners. So basically, like any other investor, their liability is limited. They're known as an LP, a limited partner. Now, why are financial investors a positive feature for PPP development? Well, basically, normally our investors might be construction companies, facilities management companies, and the money that's put in as equity, there'll only be a finite amount of that money available from the corporate. So what happens often is that after an asset is built, the construction company wants to buy out its share in the company, because it's got its money back from the construction. So we actually don't normally allow the construction company to leave straight away because we want them to understand that they're responsible for the risk. So let's say they're required to hang around for 2 or 3 years. You might not be able to do it that longer than that because of constraints on perceived constraints on doing business. So, but anyway, we'll say, look, you've built the asset, you've now hung around for a couple of years, you can now sell your investment. And the great thing about financial investors is they're just worried about their money itself. So they want to come in, put money into the deal. They're not going to be construction contractors. They're not going to be financial whiz kids. Basically, they are going to just put this money in to make that investment. So availability of finance is one of the key elements. Financial strategy includes the analysis of two potential options: short-term loans and long-term loans. So long-term loans were were the norm before the financial crash of the 2007-8, but it's not necessarily the case anymore. And now we expect to see short-term finance followed by long-term bonds. So the guide dedicates a specific heading to the role of multilateral development banks and which instruments and type of support they may grant. So the first one that may come up as a question is AB loan structures. There are only a couple of lines in the guide that talk about AB loan structures, so learn it. Essentially, we may have a country that has a poor record of making payments, and therefore it might take a year. So how do you resolve this? So basically, you can't. What you have to do is to go through the MDB. So this country is not well, it's not that it's not viable, but it might have a reputation for just not paying for a long time. So the private sector just doesn't want to get engaged. It doesn't want to make any loans. So what happens is the multilateral development bank comes in. It basically provides a loan, and then it splits the asset into two, and the risk of repayment actually is with the authority, but the other party then has to basically make a payment. So what actually happens is that the loan is stripped down. The risky bit, which is the country risk, is stripped out, and that stays part of the A loan, so that the multilateral development bank has the risk associated, the country risk, because it's retained that within the within the deal. Sorry, I got myself a bit confused there. Right, let's start again. There is country risk so the MDB takes out the loan. It then wants to syndicate that loan to the private sector, but the private sector don't want the country risk in it and similar. Otherwise, they would have bid for it in the first place. So the A loan retains the things like the country risk, and all of that stripped out of the B loan, so that the private sector, when the risk is syndicated, they are taking the B loan, which actually it has these risks stripped out of it, so it's less risky. Right, sorry about that. Okay. Also, it means they're more willing to, obviously, to lend money. The MDB can also give guarantees. It can actually put equity in as well, and it can also provide other kinds of support as funders. And you might want to check out the box which talks about the role of the ECAs. Now, the export credit agencies also provide insurance. They may provide funding for advisors or advisory work, but they don't tend to provide the long-term finance. So just to be aware. Then we have a variety of different terms in Islamic finance. One of these may turn up. Just be aware of them. Then we have our point about co-financing as a mix of public and private finance. So a government in which circumstances in which a government may decide to provide financial support to a PPP project. Well, the first is project economically viable but not financially viable. The lack of availability of private finance lending. The project is too large or too risky. The decreased WACC and increased affordability, and so on. Okay. Right, so we're now going to take a very another break now. We'll have a very short break much later on, but we're now going to have a 10-minute break until the hour. Okay, so we have grants, but we also have revolving forms of support. So revolving forms of support is just typical loans. You can have hard and soft. So hard are the hard loans where you have commercial terms, but soft are where the terms might be, you might have a lower interest rate, you may even have an interest holiday, a payment holiday, and so on. So those are the sort of things that could be provided as an alternative to pure co-financing, in other words, grant finance. And you can actually have something that's called the term is co-financing, of course, is to do with those pure grants, yeah. But we also we might actually have these loans as well. So people, if they do that, they may actually talk about the loan specifically rather than talk about co-financing, which people think of as being a grant. Anyway, you will have a number of issues around the support that's provided. Whenever you provide public sector support, then the view is that it's actually it can be taking risk back to the public sector and therefore reducing value for money. Now, the government may wish to be an equity partner for a number of reasons. One of them is that it may just want to know what the SPV is up to, what its profit figures are, and so on. However, in some countries and in some markets, the private sector don't really like the government to be engaged with them as an equity shareholder, because they believe that the government may not really understand how the private sector works and that they will be interfering. There are other markets and other sectors where actually the private sector are delighted that the government is an equity partner, because it shows the commitment of the government to a project. So very diverse views, and obviously the level of equity involved and the nature of that equity can make a difference. Okay, so the public sector, such as MDBs and so on, may look at helping to de-risk a project to make it more interesting for our lenders. And those techniques could be, for example, guarantees, and also dealing with foreign exchange, that sort of thing, and credit enhancements as well, such as the A or B loans. Right, other considerations regarding the project company's financial structure are the lender's rights, limited leverage and requiring minimum equity, things like transfer of shares and changes in control, refinancing gains. And again, for each of these, please make sure that you've read about them, in particular, lender's rights, refinancing gains. And also require or not requiring the financial package up front and the risk of financial close, and preferred bidder funding competitions. So when a bidder submits their bid, they must always, almost always, they are required to bid in the level of equity, the percentage of equity that they are going to put into the bid, because that is part of the bidding process and needs to be evaluated. So if you have a question that says something like, when is the equity normally bid, or is provided, it's not provided at the bidding stage. Obviously, the equity is only actually provided at the when the SPV is set up, but it's bid in and it's agreed at the bid stage, or in fact prior to the bids being submitted. Now, there is an issue about borrowing and finance from the market. So sometimes the competition is such that the bidders are required to come with their own banks, their own lenders, and therefore we might also be expecting to see heads of terms from those banks to show that they are supporting the bid. Or we might not require that at the bid phase. As long as the equity has been bid and put into the bid itself, then what we might do instead is, when we get to contract award, we then run a financing competition amongst the marketplace. And we are hoping then to get the best deal that we can possibly get. When bidders come along and individually come forward with their own plans, their own lenders and so on, the problem is that if we don't shortlist those bidders, we might lose those lenders, and yet they may have had some of the best terms. So instead, we could have this competition that takes place much later on at the award stage, and then we'd hope to get competition across the market for this particular bid. Of course, one of the problems with it is that it does delay process. Apart from anything else, when bidders come along with their own banks, those banks will have done their due diligence as we were going through the process. Whereas with a funding competition, all of that due diligence by the banks happens to be at the end of the process. So it can extend the procurement period. Right, so lenders will decide on the basis of cash flow and the debt profile as to how much they're going to or how they're going to invest, if at all. They will undertake sensitivity analysis, analyze the risk structure of the contract, and exercise tight control over the cash flows. Now, there's also something called the waterfall, and this often generates questions as well. Now, at the top of the waterfall, your SPV will get revenue in. Then there will be costs that need to be paid out. And then there is an order that these costs have to be paid out. So the first thing you have to pay for from your revenue are your operating costs. Then you're going to have to make reinvestments in the business, such as might be something to do with the maintenance. Then we have to pay our taxes. Then we have to make our debt repayments, principal and interest. Then we'd have reserve accounts and then equity investments. And a question that typically comes up is, what happens after you've repaid your operating costs, or what happens before reinvestment in the waterfall, in which case the answer would be operating costs. Right, well, with project finance, we have the opportunity to share risk, to extend the debt capacity and release cash flows and maintain a competitive advantage. It enables companies to avoid issuing corporate repayment guarantees, because we said before, the parent companies don't necessarily want to be exposed to the SPV, the SPV's liabilities. So therefore, they won't have, or they'll try and avoid having any recourse. Now, there is limited recourse rather than zero recourse in PPPs, and that's normally during the construction phase. There'll be limited guarantees given by a parent company. It also enables the sponsor to finance the project based on the lender's credit rather than their own, and it permits the sponsors to share the project risk with other stakeholders, reducing their own risk within the project company. It empowers the providers of funds to decide how to manage the free cash flow, and it may enable the sponsors to maintain the confidentiality of valuable information about the project and maintain a competitive advantage. But remember, putting project finance together is expensive.